is tomorrow the best currency for institutional investors? Leroy Lawrence from Quadron Capital joins me in the studio right now. Leroy, welcome.
Thank you.
Now, let's just start things off. From your point of view at Quadron, why do investors turn to algorithmic trading?
There's a number of reasons. Whether you're a family office or a fund of fund, the basics of what you're looking for as an investor are normally the same. First of all, you're looking for quite predictable, steady returns, continuous profits month in, month out. That's the ideal. And also you're looking for tight risk management. Everyone talks about risk management, but with algorithmic trading, you're able to make an easier job of restricting the kind of emotions that would go with a manual trader. What you'll quite often find is that an investor will park part of their portfolio, part of their mandate with algorithmic trading, especially high frequency and medium frequency as we do, to allow them to feel a bit more confident in the kind of returns they're going to receive, and also the limits on risk that they're going to see.
Okay, so that's some of the benefits there. Do you think with those sort of factors in mind that the markets are likely to see an increase of this type of trading?
Yeah, definitely. All of the signs are pointing to a massive increase in automated trading, at least. With the market in general, including equity as well, you're looking at about 50% of the market is traded in an automated way, about 60% in the US. With spot FX specifically, it's about 20. Well, we're looking to grow to about 25% by the end of 2015. So, if it's working, it grows. It's growing, so therefore I think it's working, and we should expect to see continued growth in this marketplace.
Okay, now that's talking about some future developments, but what other factors might affect the currency markets in general and traders moving forward?
Okay, well, there are always concerns. Confidence is the key thing with any kind of marketplace working. If you're a manual trader, you're going to be concerned that the markets don't make as much sense as they used to because of all these algorithmic trades that are taking place that seem a bit mindless. So you often get complaints from manual traders that, look, we're trading our normal strategy, but it's not working in the same way. But all that really implies is that there's change and you have to adapt or die ultimately. And of course, the first party to take this up and try to make sure it's not unfair are the regulators, especially in Germany and in India. The regulators there, they have been suggesting ways of ensuring fairness, that the market's not manipulated. Some of the suggestions have been a 500 millisecond stop in between each trade, a little breathing period between each trade, so the high frequency traders can't just drop in millions of trades super quick that no one else can understand, let alone keep a track of. Also, the other suggestions have been licensing, so that if you have an algorithm, you have to supply that algorithm to your local regulator and they have to approve it. But the questions are, how much does that code really mean to the regulator? But ultimately, there hasn't really been any proof that there has been market manipulation or any real negative effects created by high frequency trading by automated systems, and therefore in the latest derivative of the MiFID II derivative, none of those suggestions were taking up, and ultimately I think we're going to see maybe some more changes from a regulatory perspective, but nothing that's too damaging as far as this marketplace is concerned. Okay,
I mean, the manipulation in trading is something which has been quite prevalent of late. Heard a lot of different examples of it, which have been quite reputationally damaging. So with that in mind, why do investors quite often work, you're from CEO of Quadron Capital, work with your managed accounts before kind of dipping the toe into the water of these other markets?
Well, we're very much a proof is in the pudding kind of company. Of course, an investor would normally come to you and they want to see your track record, your back testing, your risk management, your methodology. We give them all that in our due diligence, of course, but also we want to earn their trust. So by an investor having a vested interest with us, so having a smaller account with us for a set period of time, they can witness hands-on, and because they've put money in, they care what's happening. It's not just we'll check it back at 6 months' time. And they can see what kind of returns we can give them, and not just the returns, but also how well we work risk management wise. That's key and the first thought for them.
Okay. Well, Leroy, thank you for coming in and sharing your and Quadron Capital's insights today. It's been an absolute pleasure.
Thank you.
Thank you. Okay, well that's all from Leroy and myself for the moment, but make sure you keep clicking back to Ricoscopy TV for plenty more of the same. See you soon.